Today, the U.S. stock market has been great for 6 years, but why now may be the time to look abroad? Then, brand visionary Scott Galloway on Netflix, Amazon, and the next big thing.
So I think the biggest thing in technology in 2017 is voice. I think Amazon is effectively inspired with voice and technology and 500 million consumers to kill brands.
Plus, a Tesla bull makes his case.
That car that they developed is a good car, and that's not a fluke.
Hello everyone, welcome to The Bottom Line. I'm Henry Blodget. Geopolitical uncertainty continues. North Korea and Turkey were major stories this week. Britain's Theresa May called for new national elections in June, surprising everyone. And next week brings the first round of France's much-watched election. Big question there is around how strong a showing we'll see from Marine Le Pen, representing a far-right, anti-European worldview. Yet against this backdrop, global economies are in a healthy growth phase. Here to discuss how investors should navigate all this is Jurrien Timmer, Director of Global Macro at Fidelity. He joins us from Boston. Jurrien, welcome. Great to have you. Let's start in the U.S. Earnings season, somewhat refreshingly, is off to a great start.
Yes, so earnings for Q1 are being reported, and it looks like with the usual drift that we get once the season is underway, usually the numbers improve a little bit. We should be able to see double-digit growth for the first quarter on a year-over-year basis, even though the comps are a little easy because a year ago, obviously, the earnings cycle bottomed. But even so, the sequential increase in earnings has been pretty impressive so far.
But despite that, you don't see as much upside in the U.S. on the stock market?
Well, I think one of the things that we need to remember is that a year ago, the global business cycle inflected higher. Earnings inflected higher across the board, no matter where you look, whether it's in China or Europe or Japan or the US. But as of a month ago, we kind of reached that, what I call peak reflation moment, where indices like the ISMs and other high-frequency economic indicators reached a momentum peak. And usually, that does not mean the end of the cycle at all, but it does mean that that's usually the point where the market goes from going straight up to a little bit more of a sideways chop, and then eventually it starts to go up again. And so for the last month or two, the stock market here in the US has been kind of correcting in a very shallow way, and it sort of makes sense from that perspective.
And so many investors over the last few years have been over-indexed in the US and done very well as a result, but you think that now is the time to diversify internationally?
Yes, so since about 2011, the rest of the world has stalled out in terms of their stock markets, while the U.S. has kept going. And when you add it all up, from the '09 low, the S&P is up 282%, and non-U.S. equities are up about 135%. So there's a very large gap of about 150 percentage points in favor of the U.S. And the U.S. has been the right place to be, especially with the dollar strong. But my sense is with the global cycle now converging, and maybe the U.S. being a little bit more in a sort of in a late cycle mode, that the rest of the world will catch up and will continue to catch up. So I think I'm quite bullish on non-U.S. equities.
And are you taking more risk in exchange for the non-U.S. equities? And if so, what's the right percentage to have outside the U.S.?
No, I see it more within the context of if you have a risk budget, if you will. So if you have a 60-40 portfolio, stocks, bonds, or 70-30 or 50-50, you look within that bucket of 60% stocks and you ask, how much should I be in the US? How much should I be outside? And usually outside the US has more volatility, which is how we define risk in our business, of course. So you have to just still deal within that risk budget. But my sense is, just speaking from investors anecdotally, that over the past 5-6 years, nobody's really had any reason to go outside the US, right? The US had not only the best return, the best relative return, but it was also the lowest volatility. So it had the highest Sharpe ratio, and so there was really no reason to go anywhere. So my sense is that people are a little bit heavy on the US, and so within that allocation to equities, they can look outside and maybe even lower their risk while increasing their returns.
And one of your big themes since February 2016 has been a global synchronized recovery, with China a big part of that. Anything you're seeing now change that?
Well, so it's an important distinction because since our election in November, and I see this when I talk to journalists, everyone focuses or everyone attributes every little move in the market to what either is or isn't happening in Washington. Will we get tax reform? Will we get deregulation? Will we get this or will we get that? And those things are obviously very important, especially for evaluation, from a valuation point of view. But it's easy to lose sight that we have been in this global upturn, and China has been front and center of that upturn. China's probably been more systemically important to the upturn than what happened here in November, just purely from an economics point of view. And so we're in this global synchronized reflation, if you will, and it's been very powerful. That's what's leading to the earnings increase. The election year has led to more optimism, more animal spirits, as we call it. But really, the hard data have not really moved yet here. So it is a big story, and it's one that I think has easily been forgotten because we're so obsessed with the latest headlines coming out of Washington. And so it tells me that fiscal reform, as important as it is, the market is not is more resilient than just to that particular new development.
And speaking of the headlines, it just seems that every day is just whiplash all day long right now with some new huge thing happening in the US, internationally. Should investors pay attention to that?
For the typical investor, if you're in the right plan, so if you're in the right allocation and you're in the right vehicles, funds, or whatever they are, your biggest challenge is to just stay with that plan. We can tend to be our own worst enemies by second guessing our plans when new things emerge, and it often leads to bad decisions. Selling at the bottom, buying at the top. We all know these stories very well, and so if you're a regular investor and you have some sort of life cycle fund or you're saving through a 401k, and your plan in terms of the relationship of risk to return, how much risk are you willing to take to get the returns that you need for retirement, for instance. If you're in the right plan, then you stay with it. Remember, the S&P over the long term goes up about 10% a year. It has its occasional pitfalls. The odds of being in a 10% correction at any time for any reason is about 1 in 3. There's always geopolitical risk. There's nothing new about the current situation. And yet, despite all of that, the market still tends to go up 10% a year. And so for us, it's important just to kind of stay out of our own way sometimes, provided that we have the right plan. If we have the wrong plan, we need to sit down with someone and figure out what the right plan is.
And so for investors who do want to invest in non-US equities, what's the best way to do it? And is there a difference between developed markets and emerging markets, which I gather from a valuation perspective are among the most attractive right now?
The US is trading at 18 times expected earnings. Non-US is trading at 14 times expected earnings. Emerging markets are at about 12 times. So there's a significant valuation advantage outside the US, but usually that's justified, right? I mean, you pay higher valuations for more stability and more performance, and the US has been by far the best house in the neighborhood since 2011. So it's totally justified. But moving forward, I think that valuation gap is going to narrow. And then the difference between developed markets and emerging markets is really a question of where's the growth going to come from, and again, how much volatility are you willing to take on in a portfolio? Emerging markets, of course, are notoriously more volatile than developed markets because, well, they're emerging markets, right? And they have a lower valuation for a reason. It's to offset that higher volatility. So it's really just comes down to a personal choice, and is often less an issue of permanent loss of capital, which I think is how most people think about risk. But oftentimes it's more a matter of just liquidity and time horizon, right? So if you're in an investment that is relatively illiquid, or it's liquid, but if it goes down 20%, you may have to wait a couple of years to recover that, and you need all your money in 12 months to buy a house, then you're in the wrong investment. So that's how I think about risk. And so it's the same thing when you're investing overseas. You got to look at the risk profile and the return profile of those investments compared to your own needs as an investor, and then you sort of pick the right choices.
Jurrien Timmer is the Director of Global Macro at Fidelity. Thank you very much, Jurrien.
All right, thank you. Appreciate it.
As we noted, earnings season is underway. Netflix reported this week, beating on earnings but disappointing on subscriber growth targets. Netflix is still a monster, though. In fact, Scott Galloway, outspoken professor of marketing at NYU, thinks this modern TV network can become the next internet mega cap, a $300 to $400 billion company.
Netflix is a juggernaut and is probably the most likely candidate to join the big four: Amazon, Apple, Facebook, and Google. And Netflix is sort of has a shot at becoming the operating system for joy in our life. Millennials spend more time watching Netflix than they do all of cable TV combined. The scary thing for Netflix is that Amazon, whose core business isn't even streaming video, is going to spend $5 billion on original content this year, more than NBC or ABC at $4 billion or HBO at $2.5 billion. Netflix is at $6.5 billion. But it shows you the power of having a company that doesn't need to be profitable, like Amazon, with that type of market capitalization, when they can go toe-to-toe with the Muhammad Ali of home entertainment, Netflix, and spend almost as much. So Netflix has a shot at breaking out and becoming a $300 or $400 billion company because of its dominance in that one sector, but I would be looking over my shoulder at Amazon.
Well, first, if Scott's right that Netflix can become a $300 to $400 billion company, there's plenty of upside left in the stock. That's about $750 a share, up about 5x from today's level. Second, Netflix now spends way more on original content than NBC, ABC, and HBO. Wow. Amazon spends almost as much. Meanwhile, I'm not sure if you caught it, but Scott said Netflix can, quote, become the operating system for joy in our lives. This is a big part of his thesis, which explains how the big four net stocks built enormous wealth by tapping into our most basic instincts.
So let's talk about the big four: Amazon, Apple, Facebook, and Google. Effectively, what you have here is companies that have grown their value in the last 8 years to the equivalent of the GDP of South Korea. We've never seen this kind of wealth creation. So the question is, how have they been able to do this? And I would argue that they tap into these very basic instincts. I think Google is God. We used to pray to say, will my kid be better? Now we type in symptoms and treatment of croup and we get a more credible answer back. I think Facebook is love. Love is empathy. A function of empathy is your interactions and your contact and your intimacy, and I think Facebook is creating that. And it's an instinct to want to love and be involved in other people's lives. Amazon is consumption. The more stuff you have, the more likely you are to survive through the winter and attract mates. And Apple is sex. Apple has become specifically, this item has become the ultimate badge of wealth, of success. Apple is sex. So we've taken God, we've taken love, we've taken consumption, we've taken sex, we've disarticulated those four things and reassembled them in the form of the enterprise with shareholder value, and have created more economic value across a small number of people than ever before. These four companies are who we are, disarticulated and then reassembled to benefit 800,000 people who are making a ton of money.
Well, there you have it. If you're scratching your head as to why Apple, Google, Facebook, and Amazon are worth so much, Scott just explained. They're selling God, sex, love, joy, and consumption. But all is not yet nirvana. As Scott also notes, the remarkable efficiency with which these companies create and provide their services is exacerbating a major problem in our economy: inequality. The big four just need far fewer people to do what they do than the last generation of industrial companies did. And that means fewer jobs and less spending money for average workers.
The economic titans of the 20th century, General Motors and Unilever, loosely speaking, they created somewhere between $100,000 and $250,000 in shareholder value per employee. And that built a lot of middle-class families, hundreds of thousands of employees making a good living around the world. Facebook has created approximately $23 million per employee in shareholder value. So it's great if you work for Facebook. It's great if you own the Ferrari dealership in Portola Valley. It's great if you own real estate in San Francisco. But the question is it good for society when so few households are benefiting so much relative to the economic titans of yesteryear that used to spread not as much money, but spread it across a much wider base?
Lastly, Professor Galloway weighs in on the next big thing: voice. You know it. Alexa, Siri, Bixby, Google Home, and all of the other new services that surround us and are powered by our voices.
So I think the biggest thing in technology in 2017 is voice. I think Amazon is effectively conspired with voice and technology and 500 million consumers to kill brands. When you go into a store, you see the packaging, you see the end caps, you might see pricing go up and down. All of these things that big brands ranging from Unilever and Procter & Gamble to Kraft and Heinz have spent billions of dollars and generations in building. When you begin ordering groceries and things and CPG products via voice on Alexa, all of those things go away. And if you look at search terms on Google and voice commands on Amazon's Alexa, the percentage of time that brand prefixes or is used in a request is declining. So effectively, I think Amazon has declared war with the backing of 500 million consumers and a lot of cheap capital on brands. And we will, using our algorithm, find you as good a product for a lesser price. Amazon will figure out in a nanosecond the best deal and most likely trade you into the highest margin product for them, which will be Amazon toothpaste.
Our thanks to Professor Galloway and the Blodget household. We're eagerly awaiting our Amazon toothpaste. Meanwhile, in smartphones, it's still Apple versus Samsung. And this week, Samsung's new Galaxy S8 hits the market. There's a lot riding on it. Samsung's new phone last year met with disaster. Batteries that overheated and caught fire. Samsung had to recall it. Happily for Samsung, the new phone is getting rave reviews. Our verdict is that the S8 is now the most beautiful smartphone in the world. The standout feature is the huge and beautiful display. It's bigger and brighter than the iPhones. And Samsung has figured out how to increase the screen size without making the phone humongous, so you don't have to lug a giant phablet around. Will this new phone allow Samsung to claw back market share from Apple? Unlikely. Apple's latest greatest iPhone is expected this fall, and it's also expected to have a big, beautiful screen. iPhone users who've waited this long will probably wait another 6 months. But still, it's great to see Samsung, which invented the giant smartphone, get back in the game. And now on to even bigger gadgets. One of the two companies that Elon Musk runs, Tesla, has eclipsed the iconic US car company Ford in market cap. It even briefly surpassed GM as the most valuable US car maker. Is this absurd or is it justified? As usual on Wall Street, it depends who you ask. Our senior automotive correspondent, Matt DeBoard, put the question to well-known Tesla bull, Morgan Stanley analyst Adam Jonas.
This crazy market cap that Tesla has developed over the beginning of 2017, displacing Ford, displacing Fiat Chrysler automobiles, and threatening and even briefly displacing General Motors. How did this happen?
Their ability to tap into multi-trillion-dollar markets. The market's at a point now where they are willing to discount with some risk premium some degree of success in a way that they're just not willing to do with the traditional automakers at this time.
Yeah, now, but is this for real? We've certainly heard Elon Musk himself make comments about how the company is sort of crazy overvalued. Tesla's selling a few more cars each year than it did the previous year, not really making any money. Is this a hallucination? Is this craziness? Or is this really a look into the future?
We think it's real. But Matt, we've seen this before. Disruption is not something that capital markets are new to. This is old hat. We saw it with Cornelius Vanderbilt and the railroads. We saw it with Thomas Edison and the electric utility grid. There were times when people thought men like these and Henry Ford were crazy. What are you doing investing all this capital? Henry Ford's bankers were pretty furious at the risk he was taking with the moving assembly line. But they did it. And once in a while, these things pay off. They don't always pay off, but Elon Musk is in that genre of capitalist, scientist, storyteller. You can argue about whether he deserves the cap, but when we engage with auto companies around the world, BMW to Toyota, etc., they admit that car that they developed is a good car, and that's not a fluke.
Do you think that Tesla has everybody freaked out at this point? Everybody I've talked to in the industry is more than happy to say what Tesla's done is really worthy of our respect. Nobody's done this for a long time. They're happy to pay tribute up to a point. But do you think they're freaked out when they go to bed at night?
I think it's a combination of losing a few winks of sleep at night and an enormous amount of respect. The industry has a reputation of being arrogant, like our cars are the best. Right?
A little bit.
And even these types of companies say, we're glad that Tesla is around in many ways. I'd say more respect than fear, but definitely some some concern.
I think you're generally regarded as being one of the more bullish Tesla analysts on Wall Street. So are they a game changer, or are they not changing that much? I mean, where do they sit?
Well, they could be a game changer and they could be at risk. Those two outcomes and scenarios, they're not mutually exclusive.
Yeah.
We think it's both.
Given the relatively gigantic market cap they've managed to assemble since the IPO back in 2010, how many cars are they going to have to sell over the next couple of years to justify this?
Well, Matt, if you just solved for numbers of vehicles they'd sell and that was it, it'd have to be quite a lot of cars. Something approaching, if not exceeding, a BMW type of scale of a couple million units a year at some point next decade, right? Certainly an order of magnitude higher than what they've been doing to this point, and to be making money doing that.
Yeah.
But we think the sooner that the market can start to view Tesla as something other than just selling machines for people to own privately and operate in some automated form themselves, or I think the more that the events of the next few years are going to make sense. We see Tesla as disrupting transportation, not just the automotive industry.
Okay, as far as the Model 3 goes, critically important car for Tesla this year. Do you think it's going to launch on time? What's going to happen? Are they going to be able to build enough of them to be able to satisfy the possibly 500,000 pre-orders they have at this point? Where's Tesla at with that car?
We think the Model 3 is going to launch on time, technically. But there's a difference between launching a car and then scaling up to high volume production.
Yeah.
And we think that that's where we differ from the company's view.
So they're saying they're going to be able to do 5,000 vehicles a week in the fourth quarter of the year, that they're going to be able to do 10,000 vehicles a week in 2018. You're skeptical about that?
Well, we think that there's some of that communication there's nothing wrong with having internal and external targets, aspirational targets to achieve an objective, and I think Elon himself had kind of communicated that these were aggressive targets, but we're going to try to do it to almost manage the supply base and bring the supply base along with them so that we could reach high, and then if they fail it was still a good result.
Yeah. So Elon himself, is he among the most important humans who've ever lived on planet Earth? Or is he just a great car salesman and a terrific technologist and an amazing businessman, or none of the above?
I'd say he's a capitalist. He's talented. He's very impressive, and one person can make, as you know, a very, very big difference when you're assembling capital and ambitious investment horizon.
Tesla isn't the only Silicon Valley company in the car business. Google and Uber are investing aggressively in self-driving technology. Even Apple is rumored to be getting into the game. What does Apple co-founder Steve Wozniak think about the potential for an Apple car? We asked him this week.
What would I like to see in autonomous cars? I'd like to have one that drives itself without a steering wheel, and I'm not seeing that happening too quickly yet. But I'm really waiting for it, and I'd like to see it affordable. When I built products, I didn't buy them, if you've got extreme amount of money, you can get into this. If you got $1 million, you could have a car that flies a little. No. I like only things that are for everyone. That's why, I used to drive a very expensive electric car, the Tesla, and then the Chevy Bolt came out with a large enough battery to go on all the driving we do. My wife and I take long road trips. I modified my whole life down to where I want to be. I want to be at the lower level like everyone else. I want to be an everyone else person. But of course, I want to follow new technology too. Self-driving cars is so huge, you read about it every day, and Apple just got a license to do that. I am hoping that the Apple car, like the iPhone, is so different, so far ahead of the others, leaps ahead. Even our Apple II was leaps ahead, years ahead of the competition, doing things you never thought possible. I'm hoping Apple has maybe the first car with no steering wheel that you really can put your 5-year-old in and send them to school. So I don't know, but you don't know. You get disappointed if you have too high of expectations. But I still think that Apple's the company that could do that and disrupt all the others.
Kudos to Steve Wozniak. He may be the only tech guru in the Valley who is downgraded to the Chevy Volt because Tesla is too elitist. That's our show for this week. Thank you very much for joining us, and thanks as always to Fidelity for making the show possible. We'll see you next week.